Gold moved above $2,000 and, more importantly, it stayed there. There was no dramatic announcement, no emergency meeting broadcast live, no single headline that seemed large enough to justify it. Just a steady push higher, a brief pause, and then a firm hold above a level that markets have tested many times before. When gold breaks through a major level and does not immediately fall back, it is rarely random. Markets test important prices the way engineers test bridges. If the structure cannot hold, it collapses quickly. If it does hold, it tells you something about the pressure building underneath. So the question is simple. Why would serious capital move into an asset that produces no cash flow, pays no dividend, and offers no yield? Gold does not grow. It does not innovate. It does not compound earnings. In a strong and stable system, money flows toward productive assets, businesses, technology, infrastructure. Gold tends to sit quietly in the background, unless something changes. When gold rises sharply, at the same time real yields are elevated, credit spreads are shifting, and bank funding costs are climbing, it begins to look less like a trade and more like a signal. Not a signal about excitement, a signal about concern. Think of gold as a pressure gauge inside the financial system. Most of the time, it moves slowly, responding to inflation expectations or currency fluctuations. But when it accelerates, while other stress indicators quietly flash yellow, it often reflects something deeper. To understand that, we need to look beyond the price itself. Start with real yields. In a normal environment, higher real yields make gold less attractive. Investors can earn a return holding government bonds adjusted for inflation. Gold, by comparison, offers no income. So if gold is rising while real yields remain firm, that suggests the motivation is not simply about chasing return. Now look at credit spreads. When the difference between corporate bond yields and government bond yields begins to widen, it tells us lenders are demanding more compensation for risk. They are becoming selective, more cautious. At the same time, bank funding costs matter. Banks borrow short-term through deposits or wholesale funding, and lend long-term. If funding becomes more expensive while long-term assets remain locked in at lower yields, margins compress. Balance sheets tighten. Flexibility shrinks. Individually, each of these shifts might not cause alarm. Together, they form a pattern. Gold, rising above $2,000, while these underlying variables shifts suggests capital is not simply rotating for profit. It may be repositioning for protection. This is where the story moves from markets to trust. Modern banking systems are built on confidence. Depositors trust banks to return their money on demand. Banks trust that their assets will retain value. Investors trust that government bonds are stable collateral. The entire structure depends on the assumption that liquidity will be available when needed. But trust is not binary. It does not disappear all at once. It erodes slowly. Then suddenly, when long-duration government bonds lose value because interest rates rise, banks carry unrealized losses. As long as deposits remain stable, those losses stay on paper. But if depositors begin to move funds toward higher-yielding alternatives, banks may be forced to realize losses. That is when accounting becomes reality. Gold does not require a counterparty. It does not depend on the solvency of a bank or the fiscal discipline of a government. It simply exists. In times when confidence in intermediaries weakens, that simplicity becomes attractive. This does not mean collapse is imminent. It means participants with large pools of capital may be reassessing risk. Notice what is absent from this move. There is no surge in retail mania, no explosive speculative frenzy. Instead, the price behavior feels controlled, measured, almost patient. That is often how institutional repositioning looks. If this breakout were driven purely by inflation fear, we would expect a different set of signals: rapid commodity spikes across the board, aggressive currency weakness, disorderly bond markets. Instead, what we see is more subtle. Bond markets remain functional. Equity markets fluctuate but do not panic. Yet beneath the surface, funding conditions are tightening. Gold, in this context, behaves less like a commodity and more like a diagnostic tool. Imagine a dashboard in a complex machine. One warning light flickers. The engine continues to run. Most passengers do not notice, but engineers pay attention to early indicators because they understand that small imbalances can cascade. That is where we are. A breakout above $2,000 that holds suggests that a segment of the market is hedging against something structural, not temporary. It suggests that the conversation is shifting from short-term inflation prints to long-term stability of balance sheets and sovereign debt loads. And this is the key shift in our narrative. The move in gold is not about excitement. It is about doubt. Not loud doubt, not visible panic, but quiet recalibration. When capital seeks safety in an asset that yields nothing, it implies that yield itself is being questioned. The reliability of returns, the security of deposits, the durability of government guarantees. So we arrive at the central tension. If gold is rising because trust is slowly declining, where exactly is that trust beginning to crack? If trust is beginning to crack, we need to understand what rule has changed. In past cycles, gold followed a familiar script. When central banks cut interest rates, real yields fell. When real yields fell, the opportunity cost of holding gold declined. Liquidity expanded, the currency softened, and gold rose. The relationship was not perfect, but it was consistent enough to serve as a guide. This time feels different. Interest rates remain elevated by recent standards. Central banks speak the language of discipline. Liquidity, at least on the surface, is not flooding the system. And yet gold has broken above $2,000 and held firm. That challenges the old framework. When a market behaves in a way that contradicts its historical drivers, it forces us to re-examine the foundation. To see the tension, we have to look inside bank balance sheets. Banks operate on maturity transformation. They borrow short-term, primarily through deposits. They lend long-term, through mortgages, commercial loans, and holdings of government bonds. In a stable rate environment, this model works well. Deposits are steady. Asset values are predictable. Margins are manageable. But when rates rise quickly, long-duration assets lose value. A government bond purchased at low yields declines in price as new bonds offer higher yields. Commercial real estate loans underwritten at low rates become riskier when refinancing costs jump. These losses are often classified as unrealized. On paper, they do not immediately hit capital ratios if the assets are held to maturity. The assumption is that time will smooth the volatility. That assumption depends on deposits remaining stable. If depositors shift funds toward higher-yielding money market instruments or larger institutions perceived as safer, smaller banks can face funding pressure. To meet withdrawals, they may need to sell assets. Once assets are sold, unrealized losses become realized losses. Capital shrinks. Confidence weakens further. This dynamic is not theoretical. It is embedded in the structure of modern banking. Now, consider the traditional belief that banks are safe because they hold government bonds. Sovereign debt has long been treated as risk-free collateral. It underpins the global financial system. But when interest rates rise sharply and bond prices fall, even safe assets generate significant mark-to-market losses. The rule that government bonds stabilize balance sheets begins to bend when duration risk is large and funding is mobile. Add another layer. Commercial real estate. Many regional banks hold concentrated exposure to office buildings and retail properties. In a world of remote work and higher financing costs, property valuations face pressure. Loan-to-value ratios shift. Refinancing becomes uncertain. Higher rates do not just slow demand. They change the math of solvency. If rates remain elevated longer than expected, these pressures do not fade quickly. They compound. Banks must manage tighter margins, higher funding costs, and asset values that do not recover immediately. This is why gold rising in a higher rate environment carries weight. It suggests the market is less focused on inflation and more focused on fragility created by those higher rates. There is another signal reinforcing this message: central bank behavior. Over the past several years, central banks around the world have increased their gold purchases. These are not speculative actors. They manage reserves with long-term strategic objectives. When they allocate toward gold, it is rarely about short-term price momentum. Reserve managers think in terms of currency, diversification, sanction risk, and systemic exposure. If a central bank reduces marginal reliance on dollar-denominated assets and increases gold holdings, it reflects a hedging mindset. Gold stored domestically cannot be frozen. It carries no counterparty risk. It is outside the digital payment rails that can be restricted during geopolitical conflict. When official institutions accumulate gold while public narratives emphasize stability, the divergence becomes meaningful. So we have two simultaneous developments. First, banks navigating unrealized losses in long-duration assets while funding costs rise. Second, sovereign monetary authorities increasing allocations to an asset that sits outside the conventional credit system. Taken together, this is not a story about runaway consumer prices. It is a story about structural strain. Gold, above $2,000 in this context, is less about a single data release and more about a shift in perception. The perception that balance sheets are more sensitive to rates than expected. The perception that sovereign debt loads are expanding faster than fiscal discipline. The perception that the architecture of trust may require reinforcement. Markets often adapt slowly until a boundary is crossed. Then behavior changes. If the old rule was that gold rises when money becomes easy, the new signal may be that gold rises when the system itself feels tight. And that raises a deeper question. If pressure inside the banking system and sovereign balance sheets is building quietly, who ultimately holds the leverage in a world where liquidity, collateral, and reserve assets are being reassessed? To answer that, we have to look beyond balance sheets and into the global supply chains and power structures that sit underneath the financial layer. To understand who holds leverage, we have to step outside the trading screens and into the physical world. Gold is quoted in dollars per ounce, traded on exchanges, and analyzed through charts. But before it becomes a line on a balance sheet, it is rock pulled from the ground. It is ore processed in refineries. It is metal transported across borders, stored in vaults, audited, and guarded. That physical chain matters more than most investors realize. Mining output does not respond quickly to price spikes. Developing a new gold mine can take a decade of exploration, permitting, financing, and construction. Environmental approvals, labor costs, and political risk shape supply. Even if the price rises sharply, the immediate supply response is limited. This creates a unique dynamic. When demand shifts meaningfully, the physical market cannot instantly expand to meet it. Now add geopolitics. Many of the world's largest gold producers operate in emerging markets. At the same time, major refining hubs and financial clearing systems have historically been concentrated in Western centers. That division creates strategic tension when global relationships become strained. Sanctions regimes have changed how countries think about reserves. Over the past decade, we have seen instances where foreign exchange reserves held in another jurisdiction were restricted or frozen. For policymakers observing this, the lesson is clear. Assets inside the global banking system are subject to rules that may shift during conflict. Gold held domestically is different. It is not a digital entry on a correspondent bank ledger. It does not require access to a payment network to exist. It does not depend on a foreign clearinghouse to settle. For countries facing currency pressure or geopolitical friction, that distinction is not theoretical. It is strategic. This is where the battle moves beyond price. The global financial system runs on settlement networks, SWIFT, messages, dollar clearing banks, repo markets, collateral chains. These systems function efficiently when trust is high and relationships are stable. But they are also channels of influence. If access to those channels can be restricted, nations begin to explore alternatives. Bilateral trade agreements, denominated in local currencies. Commodity exchanges priced outside the dollar. Regional payment platforms. Gold plays a quiet role in this transition. It is a neutral reserve asset. It does not belong to any single country's balance sheet. It can serve as collateral in trade agreements or as a store of value during currency volatility. Emerging market central banks have increased gold purchases not because they expect daily price spikes, but because they seek optionality. Optionality against currency depreciation. Optionality against external pressure. Optionality against a world where alliances shift. Commodity exporters. Particularly energy producers face similar calculations. Energy trade corridors are evolving. Some oil and gas transactions are increasingly discussed in currencies other than the dollar. While the dollar remains dominant, even marginal diversification signals a desire to reduce concentration risk. Each incremental change may seem small, but collectively, they reshape financial alliances. When reserve managers accumulate gold, they are not betting on panic. They are adjusting to a multipolar environment, one where trade, finance, and security are more fragmented than in the previous era. Physical gold flows reflect this shift, bullion moving from west to east, vaulting strategies changing, repatriation of national gold reserves becoming more common. These decisions are slow and deliberate. Headlines tend to focus on daily volatility, a $30 move in gold, a percentage swing in equities. But beneath that noise, sovereign actors are making long-term adjustments to their reserve composition and settlement preferences. This is the real battle. It is not a battle between bulls and bears. It is a negotiation over monetary sovereignty, over who controls collateral, over which assets remain unquestioned in times of stress. When gold breaks above $2,000 in this context, it reflects more than retail demand or hedge fund positioning. It reflects a structural bid from institutions that view gold as insurance against geopolitical and financial fragmentation. And as more countries seek to insulate themselves from external shocks, the architecture of global finance becomes more complex. Which brings us back to money itself. If supply chains, sanctions, and strategic reserve shifts are altering the balance of power, what does that mean for currencies built on expanding debt and persistent deficits? And how does gold fit into a world where sovereign balance sheets are already stretched? If the architecture of global finance is slowly fragmenting, then the pressure does not stop at trade corridors or reserve vaults. It flows directly into currencies. Every currency ultimately rests on a sovereign balance sheet. That balance sheet is shaped by tax revenue, spending commitments, and accumulated debt. When deficits persist year after year, debt expands. When debt expands, interest expenses rise. And when interest expenses rise in a higher rate environment, the math becomes more demanding. Governments today are issuing large amounts of new debt to fund existing obligations, social programs, defense budgets, infrastructure, and interest payments on prior borrowing. Each new issuance must be absorbed by someone. Pension funds, insurance companies, foreign central banks, commercial banks, or private investors. For decades, global demand for sovereign bonds, especially U.S. Treasuries, appeared deep and reliable. Foreign reserve managers accumulated them as safe assets. Domestic institutions relied on them as pristine collateral. The assumption was steady demand at reasonable yields. But demand is not infinite. If foreign buyers begin to diversify, even modestly, and if central banks step back from aggressive bond purchases, the burden shifts inward. Domestic banks and institutional investors must absorb a larger share of issuance. That concentration creates sensitivity. Banks already holding significant amounts of long-duration government bonds may find themselves increasing exposure just as fiscal deficits expand. This deepens the link between sovereign risk and banking stability. The system becomes more internally interconnected. Now consider confidence. Sovereign credit risk in developed economies is rarely discussed in dramatic terms. Default is not the immediate concern. Instead, the question is sustainability. Can debt grow faster than the economy indefinitely? Can interest expenses rise without crowding out other spending? Can deficits remain elevated without consequences for currency purchasing power? Currencies do not usually collapse overnight. They adjust gradually. A slow erosion in real value, a steady rise in the cost of living, a subtle shift in how much income buys over time. This is where gold intersects with money. Gold often strengthens, not because hyperinflation is imminent, but because long-term fiscal discipline appears uncertain. If markets sense that debt will be managed through financial repression, keeping rates below inflation, or through persistent currency dilution, gold becomes a hedge against that trajectory. Dollar liquidity also plays a role. The global financial system depends on access to dollars for trade and debt servicing. When liquidity tightens, stress emerges in funding markets. When liquidity expands, asset prices often rise. Gold responds to these shifts, but not always in simple ways. If liquidity is injected quietly to stabilize banks or sovereign debt markets, gold can rise even if headline inflation moderates. It reflects awareness that stability may require ongoing monetary accommodation beneath the surface. This is not a collapse narrative. It is a tension narrative. The tension between rising debt and political limits on austerity. The tension between high interest rates and fragile balance sheets. The tension between currency strength and export competitiveness. Gold above $2,000 in this environment signals that some participants are preparing for a prolonged period of imbalance. Not chaos, not immediate breakdown, but structural strain. Over time, small adjustments compound. If governments rely increasingly on domestic institutions to finance deficits, and if central banks intervene to manage yields, the line between fiscal and monetary policy blurs. Economists call this fiscal dominance. Markets call it uncertainty. Currency debasement in modern economies is often subtle. It appears as asset inflation, rising nominal prices, and declining purchasing power, rather than overt devaluation. It is experienced gradually by households through higher costs of housing, education, healthcare, and essentials. Gold does not solve these imbalances. It does not generate growth or reduce deficits, but it exists outside the credit system that creates those imbalances. That is why its strength matters. It suggests that, beneath the surface of stable exchange rates and orderly bond auctions, investors and institutions are reassessing long-term sustainability. And once we accept that this is about structural imbalance rather than short-term volatility, the next question becomes personal. How do these macro tensions filter down into daily life? How do sovereign balance sheets and global liquidity translate into mortgage rates, business loans, and the financial decisions households face? When sovereign debt, banking balance sheets, and global liquidity begin to tighten at the same time, the effects do not remain confined to policy meetings or trading desks. They filter into everyday life, often quietly at first. Banks sit at the center of this transmission. If a bank is managing unrealized losses on bonds or facing higher funding costs, its priority shifts. Instead of expanding its loan book, it focuses on protecting capital ratios. That means tightening lending standards. Fewer marginal borrowers qualify. Credit lines are reviewed more carefully. Commercial loans are priced higher to compensate for risk. For households, this shows up in mortgage rates that remain elevated even if inflation cools. It appears in stricter approval processes for refinancing. It surfaces when small businesses struggle to roll over loans that once seemed routine. Credit is the fuel of modern economies. When its flow slows, growth slows with it. This does not require a crisis. It only requires caution. Asset prices are also sensitive to credit conditions. Real estate depends heavily on financing. Private equity relies on leverage. Even public equities respond to the cost of capital. When borrowing becomes more expensive or less available, valuations adjust. This is why macro stress matters beyond headline. It influences the price of homes, the availability of jobs, and the expansion plans of local companies. To make sense of this environment, it helps to adopt a few simple mental models. The first is the balance sheet model. Every institution, including banks and governments, operates with assets and liabilities. Stability depends on the relationship between the two. If asset values fall while liabilities remain fixed, equity shrinks. When equity shrinks, flexibility disappears. Households operate the same way. Income, savings, property, and investments sit on one side. Mortgages, loans, and obligations sit on the other. Understanding personal financial resilience begins with seeing this structure clearly. The second is the confidence loop. Financial systems are built on expectations. Depositors leave funds in banks because they expect stability. Investors buy bonds because they expect repayment. Businesses hire because they expect demand. Confidence reinforces stability, but doubt accelerates exits. If enough participants question safety at the same time, withdrawals increase. asset sales rise, and volatility feeds on itself. Most of the time, confidence is steady. But when trust weakens at the margins, behavior changes quickly. The third is the liquidity funnel. In periods of stress, capital does not disappear. It concentrates. The strongest institutions, the most liquid markets, and the most creditworthy borrowers receive funding first. Smaller entities face higher costs or reduced access. Understanding where you sit within that funnel matters. Large multinational firms often maintain multiple funding channels. Local businesses may rely on a single regional bank. Households with strong credit histories navigate tightening more easily than those without. These models are not predictions. They are lenses. When gold breaks above $2,000 in an environment of structural tension, it signals that some participants are preparing for scenarios where balance sheets are tested, confidence is challenged, and liquidity becomes selective. For individuals, the question is not whether collapse is imminent. It is how to think in probabilities. Diversification becomes less about chasing returns and more about reducing concentration risk. Counterparty exposure becomes a practical consideration. Where assets are held, how accessible they are, and under what conditions. Time horizon becomes critical. Short-term volatility may feel intense, but long-term structural trends unfold slowly. Gold's strength, in this context, is not an instruction, it is information. It suggests that large institutions and sovereign actors are hedging against imbalances that may take years to resolve. It reinforces the idea that systems under strain tend to adjust through tighter credit, slower growth, and gradual currency shifts rather than immediate collapse. For households and businesses, the most productive mindset is measured awareness, recognizing that cycles change, that easy credit does not last forever, that resilience often matters more than optimization. We began with a price breakout. We traced it through banking fragility, global power shifts, and sovereign balance sheets. Now we stand at a crossroads. If these pressures continue to build, how might the system evolve from here? Will policymakers stabilize the structure quietly, or will adjustments become more visible? We have traced a signal from gold's breakout through banks, sovereign debt, global supply chains, and household balance sheets. Now we have to confront the uncertainty ahead. Financial systems rarely move in straight lines. They bend, they adapt, they absorb pressure in ways that are often invisible until a threshold is crossed. The future from here is not binary. It branches. The first scenario is stabilization. In this path, central banks recognize emerging stress early. Liquidity facilities expand quietly. Regulatory flexibility increases. Funding markets are supported before fear spreads. Banks manage unrealized losses over time rather than all at once. Credit tightens modestly but does not freeze. Economic growth slows but avoids contraction. Gold remains elevated above $2,000, reflecting lingering caution, yet it does not accelerate dramatically. The system bends under higher rates and fiscal strain, but it does not break. In this outcome, the breakout is remembered as a warning flare that policymakers addressed in time. The second scenario involves expanding banking pressure. Here, higher rates persist longer than expected. Commercial real estate refinancing becomes more difficult. Deposit competition intensifies. Regional banks face continued margin compression. Unrealized losses turn into realized ones as balance sheets shrink. Credit availability tightens meaningfully. Small businesses feel it first, then households. Risk premiums rise across asset classes. In this environment, institutional investors increase hedges. Gold attracts additional flows, not as speculation, but as portfolio insurance. Prices move beyond $2,200, perhaps $2,400, not because of panic headlines, but because capital is reallocating systematically. The confidence loop weakens, and liquidity funnels toward the strongest entities. This scenario does not require collapse. It only requires sustained pressure without decisive relief. The third scenario is more structural. Governments facing rising interest costs choose to manage debt burdens through policy. Yields are influenced directly or indirectly to remain below nominal growth. Real rates drift negative over time. Fiscal deficits persist, but financing remains possible through coordinated monetary support. This is sometimes described as fiscal dominance, where monetary policy adapts to fiscal necessity. In such an environment, inflation may not surge uncontrollably, but purchasing power erodes gradually. Savers earn less in real terms. Asset prices reflect abundant liquidity. Gold, under this path, becomes a strategic reserve asset again in long-term portfolios. Not a crisis trade, not a short squeeze, a structural allocation reflecting diminished confidence in fiat purchasing power over decades rather than quarters. Each scenario is plausible. None is guaranteed. Markets are complex adaptive systems. Feedback loops amplify small changes. A minor funding stress can remain contained or cascade if confidence shifts abruptly. Nonlinear behavior is common. Slow deterioration can suddenly accelerate when thresholds are crossed. This is why the breakout above $2,000 matters. It sits at the intersection of these possibilities. If stabilization dominates, gold may consolidate and drift sideways. If banking pressure expands, it may accelerate higher. If fiscal dominance becomes entrenched, it may redefine its role in global reserves for a generation. But the key question remains the same as it was at the beginning. Was this move about inflation? Or was it about trust? Trust in bank balance sheets. Trust in sovereign debt sustainability. Trust in the long-term purchasing power of currency. Trust in the plumbing that moves trillions through the global system every day. Gold does not answer that question directly. It reflects how participants are positioning around it. As we close, the focus narrows. Because beneath sovereign debt statistics and central bank reserve strategies lies a more specific layer of vulnerability. Regional banks with concentrated exposure. Commercial real estate loans facing refinancing cliffs. Balance sheets that look stable under one set of assumptions but fragile under another. In the next episode, we will examine where hidden leverage sits inside those institutions, how interest rate sensitivity interacts with property valuations, and why that layer may determine whether this gold signal fades quietly or marks the early stage of a much larger monetary shift.